On February 28th, the US and Israel launched major military strikes against Iran. Now, they were initially targeting nuclear facilities, military leadership, and command infrastructure. And within 48 hours, oil was up, stocks were rattled, and the bond market did something that could actually be good news for multifamily investors. And we're going to break it all down today. Now, just to recap, right on February 28th, these coordinated strikes began. A little bit out of the blue, right? Nobody was sort of expecting it to happen. These targets that I mentioned earlier, nuclear facilities, military leadership, and command structure, as well as taking out the supreme leader, Khamenei. So with that, Iran started retaliating, right? So they're striking Gulf infrastructure as well as U.S. military bases in the region. Now we're a week or so in, and the thing is shifting day to day. Initially, it was interesting. The bond markets reacted with treasuries actually dipping to their lowest level in the past few years. But within a day or so, they started kind of fluctuating back and forth. So we're really in this pattern where we're not exactly sure how all this is going to play out. So we wanted to record this episode to talk about some things as an investor you should be thinking about in terms of protecting your downside as we enter this period of uncertainty and war. So with that, once again, immediate reactions. Oil spiked dramatically. In fact, in the United States, as of today, we're recording this on March 10th, the average cost per gallon of gas is up 40 cents, right? And that has wide ranging effects across the economy. Often we think about oil as gasoline, but oil is plastic. It's in so much of everything we buy and consume that it will send shockwaves throughout the broader economy. And part of it is driven by the fact that Iran has now closed the canal there, Hormuz. And so ships aren't able to get through. Now, there was some initial thought that the US was sort of strategically aware that this would happen because so much of the oil that flows through that canal is actually going to Russia and China. So, sort of a little bit of economic warfare, if you will, on some of those adversaries, Russia and China. But at the end of the day, if oil prices go up, they go up for everybody. So we're seeing a lot of volatility in the stock market, a lot of volatility in the oil markets, and there's going to be wide ranging impacts that come from that. Now, once again, this stuff is moving so quickly. We're not going to get into the numbers because I did mention the gas thing just because that was top of mind for me today. But, in a week or so, it may be up, it may be down, right? So it's happening. It's a very fluid situation. So at the end of the day, we wanted to really focus on what does this mean for investors? Now, if you're interested in learning more about Ferris Capital Partners and want to find out a little bit more about how we're finding and acquiring incredible Class B assets in A and B markets and improving them, thereby driving additional value to the building with the goal of doubling your equity in 5 years, go to fulloutinvesting.com. That's fulloutinvesting.com. We have a sample deal deck. You could book a time to connect with Mark or myself, as well as watch a video on our 10-step process to sourcing the best possible assets for your investment dollars. Now, financing in the short term, a lot of volatility, right? So you need to be very mindful of what's happening with treasuries on a day-to-day basis. So for example, we have a letter of intent out on a deal as we speak. We submitted one last week and we anticipate submitting a few more in the coming weeks with the goal of locking down at least one or two deals in the next month. So treasuries are top of mind for us. We're watching them every day. We're staying in close contact with our lenders because ultimately that rate we receive at the deal, when we close, could have a dramatic impact on the viability of the deal. So you have to be very mindful and we have to underwrite very conservatively. And we generally do that anyway. So if the treasuries are at a certain point, we always net it up a little bit, just anticipating that in that period of time between going under contract and actually locking our rate, if rates were to go up, we're protected. But if they go down, we have a lot of upside. So actually, our most recent acquisition, Ferris Residence Noonan, was a great example where we anticipated a higher rate because we were just being conservative, but our rate came in much lower. And so right out of the gate, we had a bit of a great tailwind coming into that deal. So we got better leverage, better debt terms, and the deal just looks better and will perform better because of that. So it's just one of those things that in today's world, especially like as we're in this kind of very fluid situation with this Iranian situation, we need to be very mindful that rates could fluctuate dramatically. So making sure we're underwriting very conservatively. So, if you see those rate dip and you have a deal you're currently operating, call your lender that day. Maybe an opportunity to refinance. If rates go up, make sure you're very conservatively underwriting these deals and anticipating potentially future rate increases that may or may not happen, right? The goal is to underwrite the deal at a place where we know we're doing everything we can to reduce risk for ourselves and our investors in the deal, but do it in such a way where we can still win the deal, right? So, in other words, there's been one or two that because of some of the fluctuations, we've had to walk away from because the rents looking good. We felt like we could hit those targeted rents, but because of potential for debt fluctuation, we just had to walk away. It was just a little too lean, right? So, this window, once again, may not last as you see these rates come up and down. We may see some Fed rate relief, although with oil prices going up, that's a big driver of inflation. So we may see the Fed pause on any future rate reduction. So it's all about being very disciplined in today's market. And this is one of the reasons why we always do fixed rate debt, because you just never know what could happen with floating rate debt. And a lot of operators that ended up in trouble today got there because they took floating rate debt in that extreme period of low rates that we had. Never seen a cycle of low rates like that. Probably won't see one again. And unfortunately, some people thought the party would never end, and it did. And then they're in a challenging situation. So, what about cap rates, right? Like, how is this going to impact cap rates? Well, uncertainty does tend to cause buyers and operators to pause, so that could mean less competition on deals in the near term. So, if the deal pencils, even with sort of those higher rates, that might make it easier for us to find deals with that less competition occurring. And so for sellers, they need to expect fewer bids, right? And they could see some cap rate expansion, right? So in other words, more risk is being built into these deals, cap rates expand. So going back to us, when we're acquiring deals, we're always assuming our cap rate will stay the same or possibly even go up. And if it goes down, that's just a win, right? So at the end of the day, it's all about conservative underwriting in this period of uncertainty. Now, Cushman and Wakefield, one of the big brokerages, are an international concern, recently put out a report sort of showing what happened after the 12-day war last year. And we did see transaction volume dip, but then it recovered very quickly once there was resolution. So, Trump is starting to signal that he thinks that this is at the end or getting close to the end, but we're also getting mixed signals from other members of the administration. And I want to be very clear here. This is not a political podcast. We could probably spend hours just talking about why we're even in this situation and whether we agree with it or not. That's not what we're here to talk about. We're just here to talk about what's the reality of multifamily investing in this climate that we're in today, right? So, if you're a buyer with capital today, this might be a great environment for you. Less competition means more opportunity, lower pricing, right? So we're leaning in, but doing it once again very conservatively. Now, this is another factor that will benefit sort of buying older buildings and renovating versus investing in new construction. Oil is in everything we build, bottom line. I mean, just literally everything from roofing, the asphalt, plastics, obviously transportation and logistics. How does the material actually get on site, right? And so, with that, supply chain disruption is possible, especially if the Strait of Hormuz continues to be blocked, right? So just global shipping lanes being impacted means that there's going to be more shipping and transportation costs if they have to go around that Strait of Hormuz. It's going to add significant cost to that transportation. And so building materials will likely increase. And so with that, it's going to be more expensive to build that newer Class A building. And for example, this is actually a stat that goes back to 2024, but from 21 to 2024, the cost to build a new single family home in the United States rose by 40%. You do get an economy of scale with building a larger building, but they're still seeing an extreme increase in that materials cost. And when you add to that land cost, labor costs, right, because of some of the immigration stuff that's happening, it's just going to be more and more expensive to build those new buildings. And at the end of the day, you can't build a building as a charity, right? You're building it to make a profit. And so their rents are going to have to be higher. So by investing in older buildings that we're turning into beautiful, almost Class A, I'm not going to say they're Class A just because they're not new. It's just not how the definition of Class A works. But at the end of the day, we're taking a Class B and offering a unit that feels like Class A with all the same amenities and bells and whistles. So really, at the end of the day, we're saying multifamily is actually a defensive play in this type of environment, right? Because at the end of the day, stocks are going to fluctuate, companies are going to be impacted by the supply chain disruptions, the increased transportation, logistics, and materials costs. And so you're going to see a lot of stock market turmoil, right? And I'm a big believer when it comes to the stock market. In fact, with my financial planner, she calls me, we have a monthly call. And I largely say, look, I'm just following your lead here, right? She's very intelligent. She knows what she's doing. We did defensively move some of my portfolio more heavily weighted towards international. So we're making adjustments, but I'm a big believer in the stock market. You put the money in, you invest wisely in well-performing companies that have a moat, and you just set it and forget it. You make adjustments here and there, but we're not in there. I'm not a day trader. I'll just put it that way. But at the end of the day, we're going to see that disruption, and that will impact other asset classes, right? Things like storage. If the economy goes into a recession, people will move their stuff out of storage and put it into their garage, right? So multifamily is a core human need. At the end of the day, people need a place to live, regardless of what's happening in the world or the Middle East or wherever. And with B class multifamily, if the economy softens, often what you'll see is renters will move down from class A into class B to save on rent. And so that kind of more affordable option that feels new is very attractive. And just the same, those same middle class, working class people that want a nice place are going to stay there. Now they may bump down an asset class too, but once again, those class A residents are going to bump down to class B. And so in our world, all of our buildings, we have a 12-month lease. So we're able to reset rents as inflation occurs and the market adjusts. So, that's another reason we love it. Now, office, luxury retail, hospitality, they're the most exposed. That's not our game. If once again there's a recession, people take fewer vacations. They're going to buy fewer things. They're going to start looking at more affordable things like companies like Walmart do really well in these types of economic climates, right? So the luxury retail, and then once again office. You may see some businesses. We're seeing it today with downsizing, right? Office has already been extremely challenged, and I think this will just add to it. So this is actually something that, interestingly enough, came out of a storage investment analysis that AAA put together. It says multifamily and self storage retain their defensive edge. Most impacts are mild unless the crisis expands or persists. Now, where I would disagree is I think storage is one of those things that will see some impact from this. They're being a little more optimistic than perhaps I would be. I actually am invested in some storage facilities, and they're doing good. And I'm not overly concerned because it's a 10-year hold, but it's on my mind more so than my apartment investments, that's for sure. And then once again, it's all about regionality. It's like that hyper local nature of real estate. So, Sunbelt markets and emerging markets, we're going to have to watch. So if oil price spikes, you're actually going to see places like Texas do really well because as oil goes up, that's more revenue and income coming into those areas where oil is a big thing. So we're definitely keeping Texas as a potential acquisition opportunity market for us. Charleston, Tampa, Sunbelt, still attractive. We're watching the employment data closely, but it goes back to why we target markets with a lot of economic diversity, not just one or two industries that are supplying most of the jobs. So, leading indicator for us right now is employment reports in those target markets and new unemployment claims in those markets. That's truly the leading indicator because that's the first thing you see. If you start to see new people applying for unemployment and that starts going up, that actually tells the story before the employment reports even come out. So let's look at a couple scenarios here. Scenario A, quick resolution, right? So maybe this just gets wrapped up pretty soon. We'll start to see things stabilize. Maybe oil normalizes, the Strait of Hormuz opens back up again. Then some of this may be a temporary disruption. So there may be a short window here of better buying opportunity as people take a step back. But once again, we believe the Sun Belt is still fully intact due to its lower relative cost of living, population growth, and job opportunity growth. Now, scenario B is a more prolonged escalation. So, if the Strait of Hormuz stays shut down or certainly disrupted, we may see a sustained oil price spike. Inflation stays elevated. Maybe the Fed then decides not to cut rates and cap rate expansion starts to occur. Once again, it's why we like to buy deals for 5-year holds so we can often navigate through these more challenging times because at the end of the day, our deal's still performing well. We have paying residents in there and the NOI is growing. But it may just not be the right time to sell if there's some disruption happening or cap rate expansion that's occurred. So we'll wait, right? We'll just be thoughtful and mindful of the right timing and wait to sell. So that's why we structure the deals the way we structure them. So, it goes back to our fixed rate debt, conservative leverage, and recession resilient assets that we acquire will win in the end. And once again, B class assets in particular are in a great opportunity due to supply constrained Sunbelt markets, really your best defensive position. So, look, this is all very fluid. It's changing by the minute. I was about to say by the hour, but it's truly by the minute. So, we'll be watching this closely and making an update as new information emerges. But the bottom line is multifamily, in our opinion, is your best defensive play in these uncertain times. So, with that, thank you so much for listening. If you enjoyed this show, please subscribe and like and share with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you and keep dreaming and investing big.